Thanks, Al, for the kind introduction. So most important thing first, technology. Let me get a hand in the back. Can folks in the back hear me? Okay. Well, I got a hand from one of my colleagues, but he hears me way too much. So let me see from a guests in the back. You can. Okay, good. And let's make sure this works. Oh, it's also exciting. Great. Excellent, excellent. Well, we're sorry the weather didn't cooperate. Obviously, rain would have been preferable, so you had nowhere else to be. But we'll get you out of here and onto the golf course or the beach as quickly as possible. So I'm Chief Muckety-Muck and Grand Poobah at Sanibel Captiva Trust. I was Director of Research at Morningstar for a while. As many of you know, of course, we are an independent trust company with having just passed about $1 billion in client assets. Quite an achievement, having started only about 10 years ago. So, you know, we are very proud and happy that we've been able to help so many of you and so many other individuals reach and maintain their financial goals, because that's really what we aim to get up and do every day. You know, we're focused on meeting the needs of our clients with very high-touch service and customized portfolios. We feel like what differentiates us from many of our worthy competitors here in Southwest Florida is our ability to customize, our ability to meet your individual needs, no matter what they are. Your needs may be similar to those of your neighbor or your colleague, they may not be. But whatever it is, we don't have a cookie-cutter solution. We sit down with you, understand what you need, and then try to craft an investment solution to achieve those income or capital growth goals. And that's the end of the commercial, so we'll move on from there. So first, I want to talk a little bit about human nature and market cycles. We'll talk a little bit about the current situation, sort of where I think we are in the current market cycle, our portfolios in the market, which are not the same thing, for those of you who don't know, and finally, what we're doing now with our client portfolios. So the first thing to think about is this you? Are you reading the paper and freaking out? This was the best picture I could find. I wanted to find somebody with like CNBC going, you know, but this was the best picture I could do. And this is not a bad description, frankly, of many investors right now and many of our clients. People are understandably skittish. The recent run in the market, you know, we're up almost 25% this year on the S&P, has actually, very interestingly in a lot of ways, created more worry than optimism among many of our clients. I love that ring, but do try to turn off the cell phones if you get a chance. You always know the new iPhone owner because it has that ring, right? Or actually, I think that was the Nokia ring. That was the one who hasn't figured out how to change it yet. So after two nasty bear markets in a year, this is actually a pretty reasonable reaction, right? I mean, 99 was very rough on a lot of people. 2007, 2008 was very rough. So there's understandably some nervousness that, you know, twice in the past decade, people have seen the market go up and then cause them a lot of pain on the way back down. So this is not an irrational reaction by any stretch. So I thought it would be worthwhile for a moment, just take a step back and look at what causes extended declines in the stock market. What are the kinds of things that cause the credit crisis of '07, the crash of '99, the bear markets of the '70s, and so forth? So one big cause is, of course, rampant speculation. You know, this happens when prices vastly exceed values, which is exactly what happened in 1999, or you have excessive use of leverage, and that's what happened in 2007, 2008. Valuations were not crazy stretched in '07, '08, but there was a massive buildup of leverage across the economy in the single largest asset class, i.e. residential housing. So that is what precipitated the crash of '07, '08. Now you can also have bear markets caused by economic dislocation. You have high interest rates and high inflation, recessions and depressions, and this describes, you know, some of the bear markets we've had in past years. You know, it certainly doesn't describe the 99-00 bear market. I mean, that was what we call a drive-by recession. The real economy didn't suffer very much then. It's just overvalued stocks. But this accurately describes some of the bear markets we had in the 70s and 80s and prior times. So keep that in mind, okay? When you see the market going up and you go, my God, I'm nervous, it's going to go back down again, ask yourself, is there rampant speculation? Is there economic dislocation right now? And I'll try and give you my thoughts on those in a few minutes. And so let's think about as well the speculative cycle. When you think about sort of rampant speculation causing a bear market, you know, you think of these two phrases. Bear markets are born in euphoria and die in despair, okay? Bear markets are born when everyone is happy as a clam and thinks the world will be wonderful forever, and the bear market ends when everyone's given up, right? And by contrast, the bull market is born when everyone's given up, but then it dies when everyone is convinced the world can never do any wrong. So where are we right now? So this is just the chart of the market. This is 1999, and this is where we are right now. So obviously 1999, lots of euphoria. 2002, a little bit of scariness. And yes, people have told me I look like that. Don't make the joke. I've heard it before. Thank you very much. I am about at least 5 years older than that guy when that was filmed. You know, 07, 08, we had a lot of excessive leverage. And then, of course, we had the crash in 07, in 08, 09. So then the question is, where are we right now? And so many people think perhaps there's too much euphoria. Market is up 25%. It's hitting all-time highs. You have speculative stocks like Netflix, LinkedIn, Priceline, all just skyrocketing and going to the moon. You know, Twitter went public, doubled the first day. How many of you out here have tweeted, by the way? Okay, okay. We have one or two. That's fine. All right. Terry has. Go Terry. All right. I can proudly count myself among the untweeters. So I am not there yet. And Tesla. I mean, Tesla's worth $20 billion. I mean, my God, this is rampant euphoria, right, guys? But on the other hand, and you knew this was coming, the market is currently valued at about 16 times earnings versus 30 times in 1999. That's a really big difference, folks. The market is trading at about its long-run average, not twice its long-run average, which is where it was in 99. This is just the chart of the price-earnings ratio of the S&P over the past decade. So you often see charts of the market going like this, you know, going nuts. But nobody often shows you the chart of the valuations having gone down. This is where we started in 1999 at 30 times earnings, and now we bottomed at about 11 times, and we've kind of crawled back up to 16. But that chart does not look nearly so scary as the one that shows everything going to the moon, right? But this is the representation of what you're paying for stocks right now, a lot less than you were 10 years ago. To give you another example, let's look at the biggest contributors to the S&P this year. So it's up 25%. What are the stocks that have pushed it up the most, and how are they valued? So this year we've got, you know, Google's trading at about 29 times. It's expensive, but it's a pretty good business. Microsoft trades at 13 times. You know, Berkshire trades at 19 times. I mean, these are not crazy nosebleed valuations. Let's go back to 1999. You know, we had Microsoft at 60 times earnings. You know, not a typo, people. Cisco at 110 times. Again, not a typo. Go back and look. It was 110 times earnings. Walmart with a 3% net margin, very efficient business, selling groceries for 60 times earnings. Gang, this is rampant speculation. This is not. And so we think that in the context of low inflation and low interest rates, current valuations are reasonable. Not cheap. A couple years ago, we said cheap. Now, reasonable is where valuations are. And it's important to keep this context that we're in of low rates and low inflation in mind, because low interest rates, they make it cheaper for companies to borrow, and corporate America is more liquid than at any time in past 30, 40 years. And it also increases the value of dividends relative to bond payments, right? If you can only get 2% on a 10-year treasury, well, I guess 3% now on a 10-year treasury, and you can get a 4% yield that's growing, well, those low interest rates make the equities more attractive. And also, low inflation increases the value of equities because they're perpetual, right? A bond might mature in 3 or 4 or 5 years. An equity, a company, it is perpetual. It has no maturity. And so that means mathematically a lower discount rate, lower interest rates, make it more valuable to me today in present value terms. So I'm going to show you a slightly hairy slide, but I want to spend some time on this because it's very important. Those of you who were at some of our market outlook last year may have seen this already, so you're a little ahead of the curve from everybody else. So this is basically the earnings yield of the market, and the earnings yield is just the PE flipped on its head. So if the PE is 10, the earnings yield is 10%. If the PE is 15, the earnings yield is 7%, or 1 over 15. An earnings yield is the valuation expressed as a yield. So you can kind of compare it to bonds, compare apples to apples. But now, as we know, what we're interested in as investors is what can we put in our pocket? What can we take home and spend? And that's real dollars after inflation. Because if I have something that's yielding 10%, but inflation is 10%, I ain't doing so well, right? Because prices are going up 10% every year. So what we're interested in is the real yield of the market, which is just the earnings yield less inflation, less the core of CPI. So you can see here in 1956, when the data series starts, the earnings yield is about 7%. The real yield is about 7%. And so from 1956 to 1968, the market did really well. It was up 8% after inflation on an annual basis. And that's because valuations were cheap here and then got expensive here. Now then, people who bought stocks at a 0% earnings yield, holding them from 69 to 82, well, they lost money, negative 1% each year after inflation. And then, of course, if you bought stocks in 82 and rode them to 2001, you made 11.5% after inflation. Again, as things go from cheap to expensive, you make money. And then, of course, if you bought down here in 01, remember how we saw the PEs in that chart going down over time? That means stocks had a big headwind over the past year. And so from 2002 to 2010, you only made about 1% after inflation because the earnings were growing, but they were fighting that headwind of 30 and 20 times price multiples. And now just recently, we're up 13% annually for the past few years. But as you can see, we had a 7% earnings yield coming down to about 6.5 now. The point being, look, we're still kind of up here, all right? We're not down here in danger territory in terms of your after inflation yield. It's a hairy chart, but it tells an important story, which is that when you buy equities at a price that is reasonable relative to the current interest rate and inflation environment, you generally do okay. And right now, we're not in super cheap territory, but we're definitely not in super pricey territory by a long stretch. So what about the economy? We've talked a little bit about why I think there's not rampant speculation in the market right now. Let's talk about that other risk of a bear market, economic dislocation. So right now, corporate earnings growth has been pretty good the past few years. And we're looking for kind of mid-single digit, maybe 7% growth in 2014. People look at the economy and they go, my gosh, there's a lot of for sale signs out there. My friend can't rent his commercial property. The dry cleaner on the corner went out of business. And they think, my gosh, the market, things must not be doing so well. But folks, unfortunately, that dry cleaner, and I'm sorry he went out of business, he's not publicly traded, okay? The deli on your corner is not publicly traded. Publicly traded companies get half their revenue from outside the US. And they sell mainly stuff you and I don't buy, okay? We don't go buy $5 million databases like Oracle sells. I mean, maybe some of you do. If you do, you have a lot more data than you probably should. But we're not going out and buying stuff like this, right? We're not buying highly engineered aircraft parts. Again, if you are and you're building a 747 in your backyard, I'd like to see it. That'd be pretty impressive. But you're probably not buying these things. And that's one reason why, although the economy has grown at a pretty slow pace the past few years, corporate earnings have grown quite nicely, partially because we don't see a lot of that stuff in our day-to-day lives, partially because a lot of those earnings are from outside the US, and partially because profit margins have been going up. Companies cut a lot of fat out in the 07-08 downturn. The housing recovery is a very welcome tailwind. Folks who are lower skilled, who may not have college degrees, they can get a much higher paying job as a carpenter or a laborer on a home building site than they can, putting groceries in a bag at Walmart. So that's a tailwind and a boost to the economy. Europe is starting to grow again. It did not implode. Greece is still there. It's not a giant smoking hole in the ground. And you're starting to see a lot of European economies grow slowly, but they're kind of bouncing along the bottom. It's no longer a drag on the global economy. And consumers and companies continue to reduce debt. So this is simply household debt payments as a percentage of disposable income. In other words, what percent of disposable income, i.e. income after paying for food and rent, are people spending on debt service? And as you can see, it was very low in 1980, got low in 95, and of course in 07, very, very high on a historical basis. That's that excess leverage in the economy that I talked about. People were spending 14% of their disposable income on credit card debt or mortgage debt or whatever it might be. But now look over the past few years. Consumers have de-levered, reduced debt tremendously. The consumer balance sheet is in way better shape than at any point almost in the past 20 years. So let's review here for a minute. Is there excessive speculation? I would argue no. Valuations are in line with historical averages. Broadly speaking, equities are not cheap, but neither are they in a bubble. They are nowhere near bubble territory. Is there economic dislocation? Well, interest rates are low, as is inflation, and both Uncle Ben and Aunt Janet, if she gets confirmed, have promised to keep rates low for quite some time. It doesn't look like there's an imminent rise in interest rates. Earnings growth is solid. It's not off the charts, but it's solid. And there are very few signs of imprudent lending. I mean, have any of you, say, refinanced your home in the past couple of years? Nobody's refinanced? Okay, interest rates are at generational lows. Somebody's refinanced their home, please. Or maybe you all just have paid them all off, and more power to you. Okay, I did, all right, gang? I refinanced my mortgage this spring, and the process relative to 2006, in 2006 it was like, you are a human being and you're breathing. Here's a loan. I mean, the due diligence was just negligible. This time, the amount of stuff I had to send them was unbelievable. Again, and this is not just anecdotal. You sort of look across the economy, lending, there's very few signs of imprudent lending right now. So what my colleague Dick Pyle would call this is the Goldilocks economy. Not too hot and not too cold. I prefer to call it the market. Not cheap and not expensive. So you can take your pick. If you're kind of a nice guy from Minnesota, North Dakota like Dick, you call it the Goldilocks market. If you're a cynical jerk like me from Washington, D.C., you call it the market. But either way, we're kind of right in the middle. Now, the next point I really want to talk about for a moment is, so we talked about the market and what causes bull and bear markets, but it's very important to remember that the market is mostly relevant if you are a passive investor who owns index funds. If you own the market, you should care about the market. And there's nothing wrong with this approach. But for our clients, they don't own the market. They own often portfolios that look very different than the market. And what affects your returns is what you own, not what is owned by the average investor. So when you hear some nattering nabob of negativism, to borrow the phrase from, was it Hubert Humphrey? Who was that? What? Agnew. Okay, I had the error right, I think. Muttering on about that the market is high or the market will do this. Well, if all you own are index funds, perhaps you should pay attention to that individual. But if you own a portfolio that looks very different than the market, what that person is saying may have very little relevance to you as an individual. So just to give you some examples, our focused equity strategy, managed by Don Jowdy back there in the back of the room, owns less than 20 stocks, and in aggregate, these companies have almost no leverage, not low leverage, but pretty much none. They are growing twice as fast as the broad market. They are twice as profitable as the average company, yet they have similar valuations to the broad market. It's like paying for Hondas but getting BMWs. That's not the market. That is a very specific portfolio that does not look very much like the market and should not be expected to perform just like the market. Our high-income portfolio owns just one utility and no consumer staple stocks. yields 5.5% with about a 3% growth rate. It's 40% less volatile than the market, and it has meaningful tax advantages because a lot of the income comes from something called master limited partnerships, which are very advantageous tax-wise. That's not the market. It doesn't look anything like the market. So what the market does not have a lot of effect on this portfolio or on our focused equity portfolio. Our process overall, so those are two specific examples with portfolios that we use for clients. But more broadly speaking, our investment process at Sanibel Captiva Trust naturally leads us to higher quality businesses. Because a company must have a sustainable competitive advantage to enter our portfolios. A company must be in control of its own destiny, have pricing power, the ability to basically raise prices and have consumers not just, hey, I'm going to go to somebody else. We don't own commodity businesses. We simply don't. And so this filter of requiring a company to have a sustainable competitive advantage, a brand or a switching cost, whatever it might be, again, makes our portfolios look quite different than the market and leads us to own, broadly speaking, higher quality businesses than the broad market. We, as portfolio managers at the trust company, are not required to own anything. If a business or industry or asset class does not meet our quality or valuation hurdles, we just don't own it. For example, we own one bank right now, Wells Fargo, just one. Banking is going to be a much tougher business for the next 20 years than it was over the last 20, partially because rates are going to be going up and not down, and partially because after basically 20 years of the regulators stepping away from banks, now regulators are crawling all over them. And that's going to reduce their returns because it increases their capital. We own 0 basic materials companies. We just don't own chemicals companies or mining companies or companies that pump oil and gas out of the ground and sell it to people because they can't control their destinies. You can have the smartest manager in the world running the best mining company in the world, but at the end of the day, he's got to sell his products for whatever the global price of iron ore and coal are. He has no control over his company's destiny. We don't like that kind of business, so we just don't own them. And again, also, although our clients tend to be older, more conservative, and income-seeking, you would think we'd own a ton of bonds, right? Nope. We've only got about 20% of our total assets under management in bonds because we think bonds are, generally speaking, riskier than they look in this environment of ultra-low interest rates. Some of you may have seen the presentation I did about this a year ago, so I won't bore you with the details. But the bottom line is that we think that bonds are far riskier than they have been historically, given the ultra-low point we are in interest rates. And so again, our portfolios don't look like the market. They look like what we want them to meet our clients' needs. So moving from there to what are we doing right now with our clients' money? We are continuing to avoid bonds. We are favoring dividend-paying stocks and master limited partnerships for income. We're focusing on business quality, high-quality businesses. We're investing heavily internationally, both for growth in emerging markets and for value in Europe. Europe is about 20% cheaper than the US right now on a valuation basis. Also has typically much higher yields. And emerging markets still trade at only about 11 times earnings. Now, emerging markets are probably not going to grow at the pace they did the past decade. China's a big part of that story, and it's certainly slowing down. But China's slowing down to 6-7% growth, not to 0% growth. And so emerging markets are still going to be growing, 2 to 3 percentage points higher than the developed world. And so we think there's a very good reason to own a chunk of those in clients for whom it's appropriate. And we're also lowering client expectations. Now I notice suddenly it gets quiet. You're like, yeah, what's that Dorsey say? What? Huh? Yeah, sorry. Cold hard truth. This is the point at which I pull the lever and the giant cold shower pours down. Equity returns for the next 5 years will be almost certainly lower than the past 5. That doesn't mean they're going to be negative or you're going to lose tons of money. It just means you're not going to have this wonderful kind of 16% plus returns that we've had in the past few years. And we saw kind of that valuations had gotten low and they're ticking up again. I'll give you a couple just data points here. Over the past 5 years, equities are up about 16% annually. So if you've owned stocks for the past 3 years, you've made 15% per year compounded on average. Over that same period, earnings are up just less than 10%. So this is not difficult math. If the stocks are up 16% per year, yet earnings are up only 10% per year, what you're paying for the stocks today is a little higher than what it was 3 years ago. And that means that right now, that tailwind of valuation we have enjoyed is no longer here. It is certainly not high enough to be a headwind, but the tailwind of valuation, we would argue, is gone. 5 years ago, the S&P was valued at 12 times, and now it's at 16 times. So further valuation expansion is possible from 16 times. It wouldn't be out of the question, but it's not something we want to bet on. It's not something we want to build a portfolio based upon the expectation that valuations will increase. Absent a pullback, which of course would increase future returns, we think that future market returns in line with earnings growth is a reasonable expectation. That is no more of that valuation tailwind that we've enjoyed recently. And so this would be probably 7% or so. You can kind of give or take a little bit, might be a little higher, might be a little lower, but if you think about earnings growth being 6, 7%, that's lower than the 16% we've had the past few years, but it's still not bad. And it's a heck of a lot better than the 4.5% flat, not growing, that you're getting in bonds right now. So we still think equities are a very reasonable place to be allocating a good proportion of your assets. But it is important to dial down your expectations. If you've stayed invested in the market, through the downturn, and you've seen this wonderful move upwards, the next few years are not going to be as good as the last few years. We also have some clients who, they were nervous, they didn't really want to get back invested after 07, 08, and now they're coming to us and saying, oh, gee, I want to jump in the market now. I want to get in now, after things have been going up for 3 years. Well, human nature is what it is, and it's okay to it's okay to get scared about things. But the point is that if you've been sitting in cash the past few years, and now you want to kind of get a toe back in the water, don't expect the 16% returns of the past few years. It is highly unlikely to happen. Expect more sort of mid to high single-digit returns. Still, a pleasant level that will allow most people to reach their goals. But it's just important to keep this in mind so you don't think you're going to get that 16% again. That's out of line with historical averages. And so we're still finding things to buy. We can still find very good businesses with good growth rates. We're just keeping our expectations in check and really encouraging our clients to do the same. So in conclusion, I just want to let you guys know, don't be this guy. This is our job. Our job is to be this guy. Your job is to be these people, okay? Yes, these are stock photos, okay, what do you want? But your job is to be over here enjoying your life. Our job is to help you enjoy your life while watching your money and enable you to do that. And any way we can help you do that, we're happy to do so.